What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. Wasn't planning on putting out a video today, but the market was pretty crazy. We talked about that on the previous brief, and, well, we got that craziness. A lot of whipsaws, closed pretty much on the lows of the day. I'm going to show you just a couple of my thoughts, some charts, just to kind of have you prepared for the remainder of the week. I'll probably, if it's another wild week on Thursday, or wild day on Thursday, I'll make another video. If not, then I'll probably just finish it up on Friday for the weekly recap episode. If you're new here, welcome to the channel. I use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. All right. Should we be looking for a bounce? We're going to talk about that in today's episode. Buckle up. Let's get into it. Alrighty, everybody. Welcome back. We're looking at some volatility charts right here. I just want to point this out. Notice the market environment, how difficult it has been to trade, all right? And then pay attention to what the volatility chart looks like. Volatility is high. It's been a difficult trading week, trading year, I should say. Well, that means simply this. When volatility is up in these levels, we're looking at Russell volatility right here, right now, at this particular point in time. People get chopped up in these high areas. If it goes higher, we're talking even crazier, dramatic price movements to the downside typically. All right, so here, down in these lower ranges, you feel like you're on top of the world. You know, when Russell volatility is way down here, or NASDAQ volatility, or even the VIX, this is the easy zone, okay? We are living right now at elevated levels, so it's very difficult to navigate. What do I mean by difficult to navigate? It's fine to be able to find support and resistance levels. However, you get a lot more swings in the market, a lot of chop back and forth, which you probably noticed today. When you get breakouts out of pivot areas on certain trades, they typically get faded. Very few actually get some follow through. As the market continues and hedge funds, institutions, and traders, they try to rotate in and out of what is working and what's not working. Okay? Right now, I'm going to say this again. I've said it for the last couple of days, since basically before we started selling off into 2022. On the 2022 prediction video that I put together, it wasn't really a prediction. It was more of just my thoughts going into 2022. It's going to be a difficult time to navigate. And during difficult times, you need to pay most attention to what you have control of. You can control 4 things, and I mention this often. 1, well, I'm not going to write it all out. Just listen to me. 1, what you buy. 2, how much of it that you buy. 3, when you buy it. And then 4, when you sell it. You don't have control if the price keeps continuing to go up. You don't have control if the price continues to keep going down. You can only control what you can control. You need to focus on risk first. If you do not focus on risk first, and you're trying to win back some losses by adding more heavier position sizes, you're going to get chopped up, including up in this range. Now, if you were down here on these volatility indices, whatever, yeah, you might feel like on top of the world, the king, the queen, the whatever. Okay, but we're not there yet. All right, take a look at the VXN. The VXN also, this is NASDAQ volatility, elevated level there too. Difficult trading environment. VIX, kaboom, difficult trading environment. Meanwhile, we've been talking about this chart. Think of a house. Yay, this is the house of stocks. It's where I live. Here's the window. That's me. This is Coco. And we're saying hi, okay? But beneath our house of stocks, right here at the foundation, are termites. Eating away, and no one even cares because the stock market is at all-time highs. We're feeling good. Meanwhile, the termites you can see here are just getting destroyed. Destroying the foundation, I should say. All right, that's the percent of stocks above the 200-day moving average in the NASDAQ composite. The NASDAQ composite is composed of about 3,300 stocks. What does this number mean? It means, like, it's at 21.58. We're talking 78% of the stocks in the NASDAQ composite are below the 200-day moving average. Are you serious? But the Nasdaq Composite is like 11% off the highs. It hasn't even like fallen. The last time we've been getting these type of divergences, bam, pandemic. All right, before that, 2018, bam. Last time before that, right here into 2015. All that fell, diverged, market was all over the place. We haven't even seen anything yet. We're hardly down. Now, will the market bounce? It's highly likely for the market to bounce. Should you cheer and be all happy about it? Proceed with caution on market bounces. All right, it's typical to get a market bounce, especially when things are so overextended to the downside. Okay, it's typical. I mean, have you seen SQ? Ticker symbol SQ. I know that was like one of the stocks. I don't have the chart in front of me, but I think Kathy Wood and the ARK Fund held it. Well, today there was like 25 million shares traded, a huge volume spike to the downside. Bam! That could easily be a capitulation type sell-off, and now all of a sudden we're going to get a bounce in SQ. So, and that could lead off to other stocks. Could be other stocks, right? Another thing that I want to point out is this. I posted this on Twitter. If you don't follow me there, you can follow me there. All right? Link in the description or in the comments, wherever I put it. It's January 19th. Okay? This is a quarterly chart. A quarterly chart. Every candle represents 1 quarter. What's a quarter? A quarter is 3 months of trading. In 3 weeks of trading, we're 50% into the previous big quarterly candle, right? It was a big bullish candle. We were like, yay! And now we're like, whoa, ouch. All right, that's not that great. Now, I want to pay attention to a couple levels because, as Wall Street defines a correction, 10%. Wall Street defines a bear market, 20%. It's highly likely to get to 10%. I mean, straight down there, I don't believe. I would imagine if we're going to get there, we're going to see bounces along the way. Okay. The reason why I'm pointing out this specifically is because that 10% correction is in line with, I guess, this previous area of resistance, support, and support. Not to mention a 5-period quarterly EMA. We haven't had a reconnect for 1, 2, 3, 4 quarters. So to get a quarterly 5 reconnect, it's likely. At some point, we're going to have a reconnect. Whether that's this quarter or following quarters, I couldn't tell you. But we have seen times, these blue arrows, where the quarterly 5 reconnects, they do act as areas of support. And when they don't, they're coming typically from some type of crazy thing that happened in the markets, and the Fed stepped in to do something. Like over here, that was like 2018 to 2019, right? We had some stuff going on then. Pandemic, kaboom! Like as soon as we got under, we just kaboom, right? So a quarterly reconnect is a level that we need to pay attention to. I don't think we're going to get down there like tomorrow, but it's a possibility to just to watch this. If we get further downside, bounce around and go down there. Let's look at the dashboard here. I wanted to keep today's episode somewhat short. Consumer staples, utilities, leaders of the pack, safety type trade, real estate. That's one that I've been watching that I think is going to have stronger relative performance to the for this month into February. Did not do so today. It is what it is. But the safety trade does seem to be on. All the indices, bam, down. A lot of bouncing around today. Tech was like, it was down, it was up, it came right back down. Literally, the market went like this. Ooh, it started off super strong, looked great. We're like, here's the bounce. Nope. Oh, wait, yes, yeah, no, yeah, no. That was today, in a nutshell. Let's look at year-to-date performance. Energy still manages to hold like 16% gains year-to-date. Meanwhile, financials was doing really good. Bye-bye financials. It's up 0.5% right now. It's one to watch because the banks can still come back, right? However, they benefited a lot from those rising yields. And during those rising yields, that held gold down. But you can see today they backed off a little bit, which will show you the charts, and gold and silver, they woke up. Yes, they did. So consumer staples is also one, creeping up that list too as well. XLP still down 1% year to date. All right, so we got to start looking at these year-to-date levels, and when they start going positive, to be a sign where that could be a very bullish sign for some of these sectors, and we'll continue to keep an eye on them as it develops. If you take a look at the 11 sectors that make up the S&P 500, we're basically sorting these from an RSI perspective, descending, so it starts off strong and then goes to weak. All right. So the strong one is energy, and you can see consumer staples from a relative RSI perspective, I should say. And, I just want to point out the majority of these, they're all well below the 20 period and the 50 period moving average. All right, so which ones aren't? Utilities, consumer staples, and energy. That's it. All right, so a lot of these things gotten beaten up. So to see a bounce at some point, absolutely. But you got to be very mindful that bounces could very well get faded. I was talking about gold earlier. Let's just show a chart today. Up 1.7%, up $30 as the 10-year yield. It was up and then backed off. And we saw just a nice big kaboom outside of this little pivot area right here. I made a gold video the other day, and I went over some gold charts that were on my eye, looking especially at the relative strength starting from January into February, how gold is typically stronger, and we're starting to see that play out. Silver was up 3.15%. I also showed a chart that showed just how amazing silver, I don't know why I'm spelling it out right now, but I am, how silver is in just almost tick by tick moving with the GDX, which is miners. It's pretty crazy. All right, let's continue on to the TNX. All right, so it was up intraday, came up, and then it started giving way a little bit. Actually, during intraday, I started noticing this, and I saw that the Qs weren't really responding. As the Qs gotten beat up right out of the gate, I was looking for an area to potentially play a bounce from. And it was when this started falling and they didn't recognize it, and then I called that out. I posted it out on the Discord. I just played a little bit of a bounce, took some profits, and then raised my stop, and then it came all the way back down. Small profits, small position. That's what you got to do, right? I'm not going to be putting full-size positions into these trades right now, especially in these environments. One thing that you can do while I'm on the topic, right? So I posted about the Qs, I posted about XLK. Okay, I was looking at XLK, or the Qs is, very similar. But TECL is a 3x leverage play on the Qs or tech, okay? So it allows you to get some more exposure, but you can reduce your cash position, right? So don't think of it as a way to go even bigger, go harder, right? I mean, you can if you want, if that's your choice. I didn't. I just did it so I can have less cash out there, but still play some sort of leverage there. All right. I went on a tangent there. Okay. So yes, yields backed off a little bit. So this huge move helped the banks out. It's been helping energy out from a relative standpoint to the SPY. This little back off though did free up that move in gold and the miners. Also, the dollar pulled back just slightly today. Nothing really too extravagant. So this is one to watch, right? Is this a topping pattern, or is it just a consolidation before a monster move up? Remember, a strong move in either direction is going to weigh some risk to the equity markets and or commodities, right? If this starts coming off, commodities could continue to do good, and commodities have been doing good. Look at the DBA. DBA's been doing pretty darn well. All right, now if we take a look at the health dashboard of the NASDAQ composite, okay, it's down 11.7%. You can see it's at the lower Bollinger Band. We cracked through the 200-day moving average. The PPO is headed down below zero. A lot of new lows have been posting. A lot of new highs, little to no new highs coming in. I will say this, when you get very little new highs, boom, boom right here, those have marked, boop, and boop, bottoms, boom, boom, and we got bounces. Is that going to be here? Maybe. But also, it's in line with some large new lows. And a lot of times when you get large new lows, boop, boop, you get bounces. So a bounce could very well come. But as I already previously stated, just because it bounces doesn't mean that we're home free. Okay, so if you are playing tactically and you want to play bounces, tomorrow could be a very great day, and even onto Friday, to look for some possibilities to see some bounces come in intraday. And you could do probably pretty well if the bounces come. For example, SQ, Right? We already mentioned that. I'm taking way too much time than I wanted to do. COMPQ under so relative strength line still heads down. The NAMO, it is actually getting to that overextended territory, which does typically sometimes produce bounces. So that's something to watch. The advanced decline line continues to fall off a cliff there too, which means if we do get the bounces, you know, you can buy a dip, but make sure that you're taking profits on that rip. Sell the rip. If you take a look at the heat map on the S&P 500, red across the board. It's no good. You know what actually really held the markets together today? This one. Microsoft ripped out of the gates, and it kind of held up there as it pulled into its 5-day moving average, and then it acted as resistance. So if you're looking at that 5-day moving average on the 15-minute time frame, which is the 130-period moving average, or the 30-minute time frame, which is the 60-some, I don't have it in front of me, 63, 60, whatever, period moving average, pay attention to that level, because sometimes while it's declining, it can act as a level of resistance, all right? Now, if you take a look at the advancing and the declining issues, once again, quite a bit of declining issues, not that many advancing issues. Once again, a little bit better than yesterday, but still a lot of capital outflowing on some pretty darn big volume. Okay, so another big down day with some volume to support that move. Now, the SPY's weekly options were pricing in that a move would probably close within this. That's where price will expire within. It's typically accurate around 68% of the time to 70% of the time. Okay? I wanted to just call this out. I re-pulled up what the options were pricing in to the end of the week. Once again, it's a little bit smaller a volatility range, but it's still big. We got 2 trading days left, and it's basically pricing it could come up to this range. Okay, and which actually would fit right back in within the little happy place. So this 455 to 460, you know, I wouldn't be shocked to see price to come up in there. Or it could come all the way down to this 445. So if we are preparing now for a bounce, I want to see more blood. I want to see more fear. I want to see capitulation. And I kind of feel it, but I don't at this particular point in time. And maybe it's just because, from my personal view, I've just been such small positions, so I don't feel the necessary big hits. But I'm also just not. I'm just not seeing it right now. Like, people are scared 2022, but I still think people kind of like, no, it'll come back, no problem. I need people to stop believing that for me to go long, if you know what I'm talking about, right? Hop in when there's a lot of fear. As far as the SPY goes, though, I would say 445 to 450. This zone in here can be a hot zone. As you can see, that's where you got to still be careful for a bounce, right? That would be taking out this low. All right, it'd still be above the 200-day moving average, which is one that we need to watch too as well. I'm going to get into the Qs because the Qs here momentarily there's a specific level that I'm looking there because the tech stocks are pretty darn, they're stretched, right? Think of a rubber band. These strong moves to the downside, they can typically, if you stretch a rubber band out, you let it go, it snaps back. That's one way to look at it, right? If we take a look at the VIX on the 30-minute time frame, still a rising wedge. We rose today from percentage basis terms. It was 4.65%. We still have these 2 gaps above us and one up north towards 45. I tell you what, if we get up to 45, the market will be in full-fledged panic. I think that the volatility can very well explode higher. It's a very strong possibility that if we do start holding down below 450, 4,500 on maybe a little bit lower, which is around 4,500 on the SPX, 450 on the SPY. There's a strong possibility that, especially this week, that far out of this range, it could very well lead to some more fear and more panic. I don't know how strong of a move, but that's why I'm kind of mapping out this level down here, which is the 445 to potentially the 200-day moving average. Okay. Let's continue on to the IWM, right? IWM is just falling off a cliff. A big portion of IWM is financials. Financials having the earnings going into this year, not doing too well, right? JPM, BlackRock. I think the one that kind of held up was Wells Fargo on the earnings. But you can see here, they're just taking hits. Even like the, biotech. Biotech's been getting hit. I know healthcare is a pretty big portion of IWM. But a lot of those, like I was looking into IBB, was the ETF, and also LABU, which is a 3 times leverage. I was looking into playing a bounce today, and as soon as I entered in, it started going in my favor, right? And it was looking fine. So then it started going in my favor. I raised my stop up, all right? Because you got to try to get to these free roll positions. And, well, we got there, and guess what? It turned right back around and stopped me out. but it went lower. So that's what's important, okay? So if you're playing a bounce, you get in and it goes in your favor, yes, and your stop's down here and it goes in your favor, you can take some profits, right? You know, or just move your stop to break even. Because if it goes like this and you're like, no, I don't need to stop. No, it'll come back. Oh, it'll come back. Oh, see, here it comes back. Here it comes back. Up. Nope. No. Whatever. I'm fine with losing a lot of money. And that's what happens. Honor your stops. Have a stop loss. Let's take a look at the cues. That's the most important one that I wanted to kind of talk about. Pulling into that 200-day moving average. Once again, the options priced in this move from about 370 into around just under 390, where the price will come back into there by the end of the week. So that means that a bounce could very well happen, but we are getting pretty extended to the downside outside of it. Now, when I looked at what the options market was pricing as far as from today's close till Friday, still a pretty darn big move. Now, this is where it gets interesting, what I want to pay attention to. There was this low that was broke. We flushed down. What I would like to see is this gap fill that lines up with this 360, and that right there, if we get just like an aggressive move to the downside here or a gap down or something, watch that level, because that right there could be going from a red to green day very quickly, and that is something that I would play into from an intraday perspective. Okay, I don't know if it'll get down there tomorrow. It's saying there's a possibility. That's what I want to watch for. We are coming into the 200-day, so that's also a possible bounce, but I'm not like overly confident at this particular point in time. So like I said, reduce risk. Now keep in mind, if we come up right out of the gates, we touch up here, and then we get back in here, that would be the safety zone. So I wouldn't be surprised to get back in that range either, right? I'm not going to zoom into the smaller frames. I got three more charts to show you. Why we could potentially see a potential bounce here is because, just take a look. A couple of things. The percent of stocks above the 50-day moving average in the NASDAQ 100. All right, this level's been just dying off. When we get these low readings, here, it wasn't even this low previously, but you can see bounce, 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 bounce. Now, the only difference between all of these, that was the 50-day. Look at the 200-day. This has been the only time on this chart that the 200-day was this low of a reading. All right, so the 200, it's just been dying off for a long time too. Just basically goes to show you the NASDAQ 100 has been trucking up, but all the stocks inside of it are not following along. Because why? Well, the mega cap stocks have been holding it together. Now, when those start to unravel, well, it brings down the other stocks with it harder, and you can see that here, and it brings down the other indices too. For example, the S&P 500. Okay, so when we get those overextended readings, we can potentially get a bounce. Another thing that I want to pay attention to is this. We're back to a positive divergence. Low, higher low, higher low, low, lower low. Positive divergence. Now, this is still pointing down at this particular point in time, the RSI. This is the bullish percent index. The percent of stocks on buy signals in the NASDAQ 100, 34%. Not that many. Okay, but when the RSI gets to this overextended area, I like to use it as a signal chart to start looking for hedge longs or playing bounces. And we're about there. Now, it's pointing down, like I said, so it could potentially still get a little bit more gas to the downside. And then I don't know if there'll be a positive divergence. But you put a couple of things in line, right? You see some support beneath us. You have the rising 200-day moving average. You have the percent of stocks, like I already mentioned, getting pretty darn low, where sometimes you get relief rallies. You got this. I talked about the termites earlier. You typically could get some sort of bounce here soon. So it seems to me, right? It seems to me that we could very well be getting a bounce here soon, but that does not mean a bounce to all-time highs. Okay, that's not like, what I'm saying is, if you're shorting into this, just make it simple. If you are shorting right now, during levels where we're getting to overextensions and signals or signal charts are getting overextended, be careful. Because it could go very well just go right in the opposite direction on you. If you are looking to short this market, you want to short a pretty large rally, especially a large rally on low volume coming into an area of resistance. And then you want to see confirmation that it's turning back around and then enter in. It gives you a low risk entry. The reason why I'm showing you a potential bounce opportunity is because there are some low risk entries setting up. They're dangerous trades because you're trying to catch basically a falling knife. I would say if the NASDAQ 100 was under the 200-day moving average, I would say then you'd be trying to catch a falling knife. As it stands right now, you're trying to play a pullback into the 200-day moving average. So I'll call that a buy the dip. If it was below the 200-day moving average and I was pointing out these levels like I do on some charts, you are trying to catch a falling knife. All right, so be careful. Last chart, summation index. We have crossed back down through zero. Womp, womp, womp. The SAR poked its little head up right there, confirming that this thing is curling back around. So there is some weakness here. A lot of times, I've seen it plenty of times though, when we cross back down through zero, you do typically get a little bit of a bounce. It's happened before. Not gonna, put too much weight on that one indicator, but it is curling back around. This thing has been diverging. It's been weakening. Not the greatest. If you look at the NIMOT, we're getting a pretty low reading under minus 150. And these typical readings also too, 150, these kind of levels down here, they have, you have seen bounces from, overextended areas there. Now, what I'm saying that I brought up yesterday is if we get that minus 300 reading, meanwhile, the summation index stays under zero, be very careful, because if they both hit down at around the same time, we've seen it here and we've seen it here where you saw some pretty aggressive sell-offs. All right, everybody, let's wrap it up. Let's wrap it up. Wrap it up. That's all I got for you on today's episode. Hope it helped out. Hope it gave you some insights into kind of what I was thinking. I think that is very possible and very likely to see a bounce here soon, but there's just a lot of pressure on the markets leading into the FOMC meeting. So just be careful here. If you've already taken big hits, reassess. Let your mind rest. Reassess. Focus on just the market movements. Practice a little bit. And then when things start going back in your favor, you can start approaching the markets a little bit stronger. Now, if you're a tactical trader intraday, there's some levels that I pointed out where you can potentially see a bounce, but you kind of already know, right? Look for bounces, but also as those bounces move up, pay very close attention to the volume on them because they could very well get faded. It's a wild market out there. Stay safe. See ya later.